Welcome to an exploration of some of the best exchange-traded funds, ETFs, available today. QQQ, with a remarkable 10-year average return of 17.38%, is among the top performers. But hold on, there's more. VGT boasts an impressive 10-year average return of 19.6%, while VTI isn't far behind with a 10-year average return of 11.15%. Imagine combining these heavy hitters into a supercharged portfolio that could make your financial dreams come true. On average, these three ETFs deliver a remarkable 15% return, making them an ideal choice for investors. Just picture this. If you were to invest a mere $500 per month for 25 years with returns like these, you'd have accumulated over $1.3 million. However, to achieve such remarkable returns, it's crucial to minimize mistakes in ETF investing. In this video, we'll delve into 3 major mistakes and how to rectify them, paving the way for you to become a highly successful investor. The first mistake revolves around the allure of total return. While it's undeniable that the ETFs mentioned earlier boast incredible total returns, solely focusing on this aspect can be a major misstep in building your portfolio. Let's dive deeper into this crucial matter. The first ETF we discussed was QQQ, and it primarily consists of technology giants, with over 57% of its holdings in the technology sector. Its top 10 holdings include renowned companies like Apple, Microsoft, Amazon, and Nvidia. However, when we turn our attention to VGT, a different ETF, we notice that it's exclusively dedicated to the information technology sector, comprising 100% of its portfolio. So, here's the catch. By investing in both QQQ and VGT, you're essentially duplicating your exposure to the same sector, information technology. Furthermore, VGT's top holdings include familiar names like Apple, Microsoft, and Nvidia, constituting a substantial 40% of the fund's holdings. This redundancy could lead to unnecessary risk and lack of diversification in your portfolio. Diversification is the cornerstone of a successful ETF investment strategy. While it's tempting to chase the highest returns, putting all your eggs in one sector or asset class basket can expose you to undue risk. The power of diversification lies in spreading your investments across different sectors and asset classes, mitigating the impact of market fluctuations on your overall portfolio. Stay tuned for the next part, where we'll delve into the second critical mistake many investors make when it comes to ETFs. Don't forget to like this video and subscribe to our channel for more invaluable insights into the world of investing. Now, let's address the issue of overlap between QQQ and VGT. When we examine these two ETFs closely, it becomes apparent that there's a significant amount of duplication in their holdings. In fact, 33% of QQ's holdings are also present in VGT, and when it comes to weight, approximately 50% of your investment is essentially allocated to very similar assets in both ETFs. So, what does this mean for you as an investor? Well, it essentially boils down to this. You might be buying the exact same assets or very similar ones, but paying for them in 2 different places. If you're invested in QQQ, which already has a substantial exposure to companies like Apple and Microsoft, and then you add VGT to your portfolio, which is heavily skewed towards Apple and Microsoft as well, you're essentially duplicating your investments unnecessarily. Now, don't get me wrong. Having some overlap isn't necessarily a grave mistake, but it could potentially lead to inefficiencies in your portfolio, particularly if it's not managed strategically. This is a point that many investors overlook. For instance, a lot of investors start with a foundational ETF like VTI or VU in their portfolio, which serves as a core holding. From there, they expand by adding other ETFs. The key is to ensure that these additional ETFs complement your core holdings and don't result in significant duplication. Now, let's dive deeper into the concept of fund overlap and why it's not necessarily a bad thing if understood correctly. When we compare QQQ to VTI, we can't help but notice a significant overlap, especially in terms of weight. A staggering 93% of QQQ's top 100 holdings are already part of VTI's portfolio. This means that if you already own VTI, a substantial portion of what QQQ offers is already in your portfolio. Additionally, when we look at specific companies like Apple, Microsoft, Amazon, Nvidia, and Google, we find overlap between these two ETFs. However, it's important to clarify that the issue isn't the overlap itself. Contrary to what some may believe, having some overlap isn't inherently problematic, especially if the companies in question are strong and you have confidence in their long-term prospects. For instance, if you're a fan of Apple and Microsoft and believe in their competitive advantages, having exposure to them in both QQQ and VTI isn't necessarily a negative thing. The real problem arises when you don't fully comprehend the extent of overlap and how it impacts your overall portfolio. The key takeaway here is that you must understand the extent of fund overlap in your portfolio. In the examples we've explored so far, it's crucial to know all the holdings within each ETF, the percentage of ownership you have, and which companies carry higher weights. This knowledge is invaluable because it helps you make informed investment decisions. For instance, if you're considering investing in an individual company and you already have substantial exposure to it through ETFs, it might not be the most beneficial idea to add more of that company's stock to your portfolio. This can result in an overly concentrated position, increasing your risk. However, if you've done your research, have a strong conviction in that company, and are comfortable with a higher level of risk, holding a significant portion of your portfolio in that company might align with your investment strategy. Now let's tackle the second major mistake, which also relates to diversification but in the context of modern investment strategies. Traditionally, the concept of diversification emphasized having little to no fund overlap and a portfolio consisting of three main components. However, as we've witnessed over the past 2 decades, this approach may not yield the most favorable results. The traditional 3-fund portfolio typically began with a portion dedicated to U.S. equities or U.S. stocks, often represented by broad index funds like the S&P 500 or the total U.S. stock market. This was considered the first part of the portfolio. The second part aimed to be entirely different from the first, non-U.S. stocks, essentially providing international exposure. Finally, the third component took a different approach altogether, moving away from stocks entirely and into bonds. The problem with this traditional 3-fund portfolio is that recent data has shown less than stellar returns for the last 2 components. For example, let's consider VXUSE, an international ETF. Over the past decade, it has delivered an annual return of just 3.7%. When we turn our attention to bond returns represented by the BND ETF, the results are even less appealing, with an annual return of a mere 1.3%. Now let's explore the philosophy of investing held by Warren Buffett, one of the most renowned investors of all time. His approach, which I advocate as well, is not to strive for extreme diversification. In fact, Buffett famously said, "Diversification is a protection against ignorance." What does that mean? Well, it means that if you're not confident in your ability to analyze and evaluate businesses, then spreading your investments across a wide range of assets may be a sensible strategy. It's a way to protect yourself from unforeseen market events. However, for those who have a deep understanding of how to assess and value businesses, the story changes. Buffett suggests that owning a large number of stocks, say 50 or 100, may not be the most logical choice. Why? Because there are only a limited number of truly exceptional businesses that can be fully understood and analyzed by a single individual. Imagine having a list of, say, 30 stocks, where the first few are exceptional businesses and the rest are merely mediocre. According to Buffett, it would be madness to allocate equal amounts of money to all 30 stocks. Instead, it makes more sense to concentrate your investments in the few wonderful businesses you truly understand and believe in. The goal, then, is not to pursue excessive diversification, but rather to aim for the best possible return with long-term safety in mind. Consistency and sustainability should be your guiding principles. Now let's address the most common and perhaps the biggest mistake that many investors make, especially beginners. It's the mistake of constantly changing your investment strategy or portfolio based on every new piece of information you come across. Earlier, we discussed the importance of understanding fund overlap and how it may or may not impact your portfolio. We also emphasize that striving for the most optimally diversified portfolio isn't always the best approach. Instead, focusing on long-term results and quality investments is key. However, the mistake we're talking about here is when investors start second-guessing their entire portfolio because they read or hear about something new in the market. They make frequent changes, often every month or even more frequently, without a clear strategy. Here's the thing: changing your investments isn't the problem. It's the method you use to make those changes that matters. I don't have access to your specific portfolio goals or preferences, so I can't tell you exactly which ETFs or stocks you should or shouldn't have. For instance, real estate investment trusts, REITs, can be fantastic for generating passive income and cash flow, possibly even more so than traditional dividend stocks. However, if your portfolio is already heavily invested in real estate, adding more REITs might not align with your risk tolerance or overall goals. The biggest mistake an investor can make is blindly copying someone else's investments without thoroughly understanding what they're investing in. Each individual's investment strategy should be tailored to their unique financial situation, goals, and risk tolerance. So, the key takeaway here is to do your own research, gain a deep understanding of your investments, and align your portfolio with your financial objectives. Avoid the trap of constantly chasing changes in your portfolio without a clear strategy. Remember, your investment decisions should be based on sound knowledge and a well-thought-out plan. If you found this advice valuable, please show your support by hitting the like button and subscribing to our channel for more insightful content.